fundsupermart.com.
Hello everyone. Today we have Stephen, the fund manager at Threadneedle Investments, and he's going to share his strategies of investing in global equity markets. What's your overall outlook for the macroeconomy in 2013, and where are the opportunities and risks?
We see an improving economic outlook for the next couple of years. 2012 was difficult, but we certainly see the US economy improving as 2013 progresses and into 2014. Out here in Asia, we continue to have confidence in healthy growth rates. Europe is the problem child, and we see those problems certainly continuing through this year and almost certainly through to next year as well.
Are the uncertainties in the US and Europe behind us, and how will the situation play out this year, and what does it mean to your investments?
We certainly see the US as improving, but all the problems are not behind us. So the fiscal cliff that was agreed at the end of last year sorted out maybe half of the problems, but they still haven't tackled the deficit and the spending, and currently we're in the sequestration period. So if the politicians can still fail to meet an agreement, then that's certainly one of the key risks for the US economy. We feel it's going to improve. We feel the politicians will get a solution, but a key risk would be if there's failure there. The European region is still a problem. We see austerity measures coming in. We've just lost the Bulgarian Prime Minister to anti-austerity protests. We've got an election in Italy that hasn't come with a resolution, potential elections this year in Spain and Greece. So a lot of uncertainty there, and really those governments need to push through austerity to restructure the economies. And if that fails, then we could see a return to some of the more serious issues in Europe. So certainly from our point of view, that would be the one part of the world where we would have the questions. And for investments, we do have exposure to Europe, but we're very careful where we invest. So our investments are focused in the UK, which we think is a stronger economy, and Northern Europe, Scandinavia, again, that didn't have the excesses that the southern countries have. So we have very little, if any, exposure to countries like Spain, Italy, Greece, and Ireland. Really focusing on the stronger economies, and also within those economies and markets, the companies that have exposure to the US economy and Asia. So not domestic European companies, but international European companies.
Which sectors do you prefer, and which would you avoid?
We have a number of themes running through our portfolios. One would be playing the US shale energy play. So production there from the shale plays in southern US, oil and gas, have grown extremely rapidly. And that's very positive for the energy companies themselves. But we're actually looking for other areas of the economy that benefit. And we're seeing chemical companies and refinery companies making very strong margins and very strong profits. And they're benefiting from the cheap oil and the cheap gas that's being produced from this new area. And all of a sudden, it's making the US economy competitive on a global scale. So they're beginning to export chemicals and finished products to Europe and to Asia because their cheap gas allows them to produce at such a low price. And that's a dramatic change that we've seen in the last 4 or 5 years. And it's why we have some confidence in the US economy, because there's this fundamental change in its competitive position. And another area that we like is the financials, particularly the private equity companies. The banks around the world, particularly in the Western markets, are still over-leveraged. They have bad debts and toxic debts on their balance sheets that they need to dispose of. And companies like Blackstone, private equity companies, have got the capital and the skills to take those assets and manage them and return strong profits. So we're looking for companies that are benefiting from the problems that banks are in, and we're finding that in the US market and in Europe.
Lastly, can you give a piece of advice for investors looking for higher return from the equity market this year?
I think firstly, be careful. The markets are volatile and there is a lot of uncertainty, but I prefer to go for lower risk opportunities and areas, and really specialize in companies with strong dividends. If you go back through history, companies paying attractive dividends have outperformed the general market on a consistent basis over 10, 20, 30 years. So investing in dividend-paying companies has been a winning strategy consistently. And when I look at the balance sheets of companies around the world with good dividends, the balance sheets are very strong. managements tend to be more conservative. So it's a lower risk strategy of investing in income stocks or dividend stocks. And we can see the payout rate, the balance sheets are strong and the payout ratio, so those dividends are growing. So you have a high and attractive yield and growing over time. And I think that's something that will be rewarded in the markets. That's certainly an area where I'm focusing my fund and finding very good returns.